Thanks for joining us for another For Investors by Investors Long Beach podcast. As always, we're proud to be your all-education real estate resource without any kind of sales pitch. If you'd like to attend one of our meetings in person, we meet on the last Thursday of the month at the Grand in Long Beach, California. You can RSVP on forinvestorsbyinvestors.com/Long Beach. To find more investment resources such as blogs and podcasts and content from other FIBI groups, you can go to forinvestorsbyinvestors.com and search our entire library. Now, on to the podcast.
Jasmine, take your time. Note Assistance Program. Our next sponsor, thank you so much for coming today. I really appreciate it. She's always in the pink outfit. It's her brand. It's the most awesome thing ever. But she's probably one of the most experienced investors I know. Tell us a little bit about what you do, man. Jasmine.
Well, Happy New Year, everybody.
Happy New Year.
All right, what I do is I like to get excitement out of the room. That's what I do. Giddy up, right? Yeah. All right. Anyway, I went to Note Assistance Program. Outside of me being a little crazy, we teach people on how to invest in non-performing and performing mortgage notes from banks and hedge funds. So, real quickly, we have a 2-day class coming up in Los Angeles, February 23rd. If you guys are interested, we can talk more about it back there. But it's really just an educational platform. We have an online platform you can join. Then lastly, we're going to be doing, for those of you here, something called our inner circle meetings, right in this building, in the boardroom right there. For those of you who have notes, if you're seasoned and you're looking for help, a lot of you buy notes and you're left on your own, right? And so we have an inner circle meeting where you get to meet with some of our members who have 10, 15, 20, 100 notes, and we all sit around and figure out how to solve your problem. So, I'm with the Note Assistance Program. We're back here, and thank you so much.
I went to her class before. I'm going to be going to the next one in April. So a lot of people are raving about it. So from what I saw, it was a lot of good detail.
We are fun.
Normally, we don't let people tell anybody else about events, but the ones that I go to that I think are valuable, I've been to a couple of them that changed my life, literally over a weekend, learning the debt strategy or something like that. And it's one of the most valuable things you can utilize is continue that education. So that being said, anybody from Park King here? So Park King is a law firm that helps with a lot of construction contracts. It helps me with and my any kind of real estate related legal issue. Concept 360. Anybody hear from them? I don't think so. They are a property management company based in Long Beach, and they'll do all of LA area. Udirect. Where is Jeff? Jeff, tell us a little bit about what you do, man.
Yeah, thank you. So we are a self-directed IRA company. And what that means is we show people how they can take their old 401ks and IRAs and move them out of the stock market into assets like real estate or notes. The IRS allows you to own a number of different types of assets in an IRA. You just have to work with a company that will agree to hold them. And that's what the self-directed company is. So our clients buy rental properties, they make loans, they invest in private companies, they buy the gas and oil wells, tax liens, number of things that they can do. Why should you use us? Because Mike is a great guy. That's why he moved on me. I took away all my time. No, we're quick. We're very competitive on price structure. Be happy to talk with you. I also have cards in the back. Thanks.
If you don't understand about self-directed investing, learn it and understand it. It's one of the most powerful wealth-building tools you can actually achieve. So. That being said, our last sponsor is New Western Acquisitions. Anybody here from there? I don't believe so. They're basically like wholesalers on crack. They wholesale properties throughout Southern California consistently and are really good at doing that. So that being said, I'm going to go ahead and leave it there, and then we're going to go ahead and get started on the panel so we don't waste any more time talking about amazing sponsors. So let me get this one up and running. Okay, cool. So I have questions here, and normally, we'll go through and keep these things moving for the audience, but this is supposed to be a Q&A. So we have some really actually a very special panel here because some of the people up here are probably some of the most experienced people that I know in the business and have been doing this for a very long time and have a ton of resources. So their knowledge base on different aspects of investing that they do is going to be really special to see tonight. And you guys will feel free to ask as many questions as you can. So typically, what we do is I'll let them have some introductions about what they do in the general, and then we'll start getting into, some of the nitty-gritty on the questions, okay? So, Gerald, let's start with you. Can you give a quick overview of, what you do and how long you've been investing and, your general bio?
Sure. And first of all, thanks for inviting us. We really appreciate having the opportunity to come up here and talk with the crowd here. My name is Gerald Lemoyne, and I'm primarily a note investor. I started off, I quit my day job in 2005, July of 2005. I got married. My wife's sitting back there in the white hat. And then it said, honey, I'm quitting my job. And she said, I hope you know what you're doing. And I had saved up some money, and I had worked in construction for a long time, and I was kind of a gypsy. I was traveling all over the place, and I knew that wouldn't be good for our marriage, so I figured I needed to find something that was more, can you guys hear me okay?
Yeah.
More stay-at-home type work, or at least in Orange County. So I started digging into note investing, and actually I started off wanting to flip houses, buying at the trustee sale. Did that for a couple of years. It started off in 2005, July of 2005. And then beginning of 2008, I discovered the note business. So we're going on 11 years now. And so we buy non-performing loans primarily. It's kind of like buying ugly houses. Instead of going out and finding a house on the MLS, it's all fixed up and pretty. We find the ugly houses, which is the ugly notes, and do the work on them to convert them into performing assets. We've probably done about over 1,000 transactions since I got started, and we currently hold about 400 notes right now. And as a result of owning the notes, we've been able to also build a rental portfolio. So we have about 10 rentals right now, most of it here in Southern California. And most of that we bought that by buying the second mortgage and then foreclosing on the property and taking it subject to the first mortgage. So we took over the financing on the home, and we make payments on that first mortgage and hold those as rentals. And by doing that, we've been able to get some really low interest rates. Like, all of our loans are under 4%. Some of them are in the 2%, 3% range. And so that's been real beneficial to us as well. So with that, that's what we do.
Love hearing about the financing stuff for this.
Great. So what about you, Iris?
Okay, so let's see. I quit my corporate job
Oh, so
in
you
2003. I'm a mortgage. My background is in mortgage finance, and I started off flipping houses, and then what happened was what I realized was I was making all this chunk money. It was fun flipping these houses, but as soon as we sold the asset, that was it, right? That asset was not going to give me any more money. So what I learned was, on top of the flipping, I had to do something else, which was buy properties and hold them. So back in the day, 2003, I was getting all this, huge chunk money, and California was getting priced out. So I totally got excited about going out of state and just went bazooka out of state and bought all kinds of properties out of state. And when you're a California investor going out of state, you go to like Atlanta or Ohio, and you're like, I'll take 3 of these, and 5 of those, and my portfolio grew really, really fast when I first started out. And then as it turned out, that was kind of a big mistake because I didn't have my systems set up. I kind of fell flat on my face, and then the market turned. Boom, boom, boom. And so now I found myself holding, at this point, like over 50 properties in all over the country: Ohio, Annapolis, New York, Texas, Atlanta, Florida, Nevada, and no control over my property managers. And I realized I was a bad manager of the managers. And so what I saw in 2007 and 2008 was the opportunity was now back in California. So what I did was I tried to sell as much as I could out of state and bring as much money back here. I mean, and admittedly, I failed. I have F's on my report. I lost, quite a few houses. Lost a lot of money in the downturn. But instead of giving up, I opened a club, created a support group, I suppose, and realized, my message to a lot of people was, I know everyone made mistakes, but if you quit real estate, then you lose everything, right? But if you hang in there and you learn from your lessons, and you can share these lessons with others, then hopefully people won't make the same mistakes as you. And what I learned was, not only what is important is, what you do, like whether it's flipping and note investing, but when to do it. So the timing is really important as well. So fast forward now, I'm primarily a flipper. All my homes are now here in Southern California. I can drive to all of them. I love them. And, my goals, I'm just going way past this, so, but yeah, I'm a buy and holder. I like to flip. So everything's here in Southern California, and I also do long-term rentals and short-term rentals.
Short-term. Awesome. Okay. Perfect. Oh, I want to go back to Joe really quickly. Why did you, you found notes. So why did you quit flipping houses and go into notes?
The note business, I think everyone has to find something that kind of fits your personality and your skill set. And when I was flipping, I was jumping in my car and driving to Hemet or wherever, and it was like, a lot of highway miles. And then you're managing contractors, doing the rehabs. And, they don't show up. They're supposed to be there at the house. You pull up and there's nobody there working. And I just happened to go to a class a guy was teaching about note investing. And I had another friend of mine who worked at a hedge fund called Condor Capital. And he told me, I was buying REOs from him and fixing them up and selling them and making some money at it, decent money. But he said, Gerald, the more sophisticated investors are investing in notes. They're buying notes. And I didn't know how to do it. But I bumped into a guy who had a training program. This was probably 2006 or so. And I liked it, and it kind of fit my personality. And so I remember in January 2008, I had a couple of $100,000 of cash, and I'm thinking, do I want to just hold money back and continue to flip, or do I want to put everything into the note business, buy all the notes? And it's kind of like sitting at a poker table, and you just go all in. I was just all in with the note business and never looked back,
Great,
so.
great. Obviously, that worked out for you. Yeah. What about you, Will? What?
So, as Matt mentioned, I've been a real estate investor for quite some time now. I started last month. I started in 2004, and I went to a big guru seminar. It was actually held at was it at the Forum? It was in LA. It was huge. The convention center. Thank you.
I think I went to that too.
Everyone in the world was there. So I got hooked on this guru guy. I had always wanted to get into real estate. I just didn't know how. So I went to this guru seminar. I got taken by this one guru for $12,500. That was their idea of utilizing leverage.
That's cheap. That's cheap.
Yeah, I was smart about it. I only lost $12,500. But the good thing about that was it made me go after my dream of what I wanted to do. I've been self-employed since the age of 19, and at that time I was kind of burnt out on what I was doing, and there was a ceiling to how much I could make in that business. So I finally pulled the trigger, and my first investments were buy and hold out of state. Very similar. I was doing stuff in Texas. And I bought one, the next one, and I didn't have a lot of capital at the time, so I utilized partners to acquire these properties. And then after a while, I started getting into land development out there. Land was cheap in Texas, so I'd buy land parcels, I would divide them up, and sometimes we'd sell them off and to developers, and sometimes we'd go vertical and build out. So I built single-family homes, duplexes, small apartment buildings. Then the crash hit. Thank God I was in Texas because it didn't crash too bad there. So I was able to sell my properties for small losses, but I sold all of my properties there except for one. And combined all that loss, I flipped one house here in LA and made it all back. So it was definitely the right move. That was 2009 when I started flipping here. And I've been flipping basically ever since. I've been investing in notes as well. A little bit here and there just for passive income. I've done short sales, wholesales, and now my focus is development. So I buy houses, I knock them down, and I rebuild them. We also are a full general contractor company, so we do service for other developers like myself, as well as retail clients, from residential to commercial.
What was the building you're quoting right now?
Oh yeah, we're actually bidding on the Sears building in LA. So that was just bought about 4 years ago. Sears is in Chapter 13 bankruptcy, and they're trying to evict Sears out of the bottom unit. The rest of the building is vacant. It is a little over 1 million square feet. It's going to have over 1,000 rental units in there, 2 penthouse suites on the top. The rooftop deck's going to have swimming pool, dog park, theater, gym. It's going to be awesome, and the views from up there, they're killer.
That's pretty cool.
So that's going to be a fun project.
That's a cool project, yeah. My name is Matthew. I'm a full-time real estate investor. I quit my job in 2006, and like them, I took a hit and kept moving forward, so that's probably the trick, because no matter what, if you first get started, you're pretty much going to take a hit, and it's a matter of what you do when you take that hit, right? Yeah, everybody's laughing because you're like, I took a hit. It's pretty much took a hit, and then now you got to move forward. That's how you learn, and that's how you lose money, and then you put different systems in place. Iris said, hey, I'm getting out of state. I said, well, I just lost a bunch of money out of state. Now I'm going to focus on the systems and get this crap right. And I was still afraid of California, going, no, the numbers are too big there, So, I basically have flipped over 700 houses now. We flip about 5 to 10 a month. We have about 10 million lent out to different flippers in different markets around the country. We do short-term rentals in multiple markets. We help run FIBI, and we do a lot of value-add multifamilies where we'll renovate everything, even down to the studs. We're doing a 16-unit right now in Little Rock that we took down to the studs, and we should be in it for about 1.2 and be able to resell it for about 1.8, 1.9 when we're finished. But I may do a short-term rental in the whole building because it increases the cash flow by like $1,000 a month per unit, and if that kind of cash flow comes in, you can't really get rid of it. So it's not easy. So Clyde is over here going, don't ever sell. What is wrong with you? Don't ever sell this building. It's hard. It's like a $700,000 capital gain if this thing works. Or 600, maybe not after taxes, but we'll see.
What say about flipping? Give me the needle.
Yeah. It's called real estate crack. You just can't stop sometimes, So, but anyways, that being said, I want to be able to ask these guys, some of the questions that I have are, geared around, the things that I think will help you guys the most. So feel free to ask questions along the way. Really, I want to start out with asking each one of you guys, and Gerald, I'll start with you, so you ruin it for the other two. What are you think are the primary resources you think are most important to develop to actually be successful at your specific niche of note investing, in that aspect? Obviously, you have to know all aspects of real estate, but what do you think are the main resources that everybody here should be developing? So,
well, for us, I think one of the main things is don't be afraid to pull the trigger. I know a lot of people that spend a lot of time, analyzing deals and looking at, attending meetings like this, and they never buy their first deal. They never buy their first note. So I would say to someone, don't wait until the perfect conditions come to get involved in the investing business. And we had to put systems together. We use a CRM called ACT, and all of our notes and all of our investors and leads and everything is plugged into this database. And it's on a network in our office. We have 5 people in my office. So it's my wife and myself plus 3 employees. And we can all put in information into this database because we're managing, 400 notes right now plus 10 rentals. And you get phone calls, you get emails, you get faxes, and all that information needs to go into a common database. So that's one of the tools that we use, a resource for us. And I think QuickBooks, we have QuickBooks set up to where it's class accounting. So every note that we have, or every rental property, has its own class, where I can look at that particular deal and say, okay, we got this much invested in it. When somebody calls us up and says, hey, I want to pay off that loan, and I can give you X dollars, and we look at it and say, is that a good enough profit for us? And, yes, it is, or no, it's not. We can counteroffer and say, but it's really important to have good accounting, good management systems in place, and, due diligence. Looking at the notes, like what Jasmine talks about, look, what's the equity? What's the title report look like? What are the property taxes at? Are there any HOAs on it? Are they current or delinquent? So there's the due diligence side of it. I could talk about that for an hour. But be careful when you're buying notes. I'll speak specifically to notes, is that there's a lot of things to watch out for. And, make sure that it's secured. Check the bankruptcy situation. Bankruptcy can lien strip a note, and it can be worth almost nothing. So and note sellers will send out a tape of notes, a list of notes, spreadsheet, and they don't guarantee anything. It's buyer beware. You do your homework, and you have to know what you're buying, and it's up to you to do the homework. So I'm not sure if I answered.
Can you talk about lien stripping a little bit on what that is?
Yeah, lien stripping is if there's no equity over the first mortgage. Like if the house is worth $300,000 and the first mortgage is $350,000, the homeowner can go and file Chapter 13 bankruptcy. I may have a second mortgage on that property for $100,000 that I might have bought for $5,000 or $10,000, $15,000, something like that. So the homeowner can file Chapter 13 bankruptcy, and they can strip the lien, which is like a cram down. It basically makes the lien like an unsecured debt, like the level of credit card debt. And so it's very hard to collect anything on it. And a lot of note sellers, they won't tell the buyer that it's a strip loan. They don't disclose that. And they don't have to disclose it. They just say, here's some loans, you look at them, make me an offer. And so I hope that I explained it adequately.
So you just have to find out if that particular person is in bankruptcy.
Yes,
or went through bankruptcy.
there's a website called Pacer, PACER.gov. And you can look up anybody that's ever filed bankruptcy on that website. So if I'm looking at a loan at 123 Maple Street and the homeowner's Sue Smith, then I'll go into Pacer, look up Sue Smith, see what her bankruptcies look like, and I'll look at the most recent one if there's more than one, and read through the docket report and see if there's any terminology in that report that talks about motion to avoid lien or motion to value property, things like that are like red flags. And then I'll read through the documents and find out if it's stripped or not. Because it's a significant difference in price, compared to like a strip lien compared to something that's secured by the real estate.
Through your 1,000 transactions, have you ever got yourself into a situation like that?
We've missed a few. Luckily, we didn't pay a lot for them. We were somewhat skeptical of it, and so we priced it low. And we've made a few mistakes like that. Yeah,
it's hard not to after that.
You're like, oh,
especially,
you have to make that mistake.
Especially in 2013, that was kind of the peak for us of buying loans. We spent about $3 million on second mortgages in 2013.
Wow.
So we kind of stocked up. It was like the feeding frenzy was on. Fill the boat up. Like Clyde talk about. Or Gary, fill the boat. And so we did, and so we were bidding, fast and furious. We were, throwing out numbers all the time, and that portfolio has quadrupled in value, or 5 times what we paid for it.
So you think basically from the note business, understanding the due diligence on the notes and getting that education, going through and learning how to raise capital or utilize other people's capital for this, as well as finding sources of these notes are the primary things that a new investor needs to probably develop in order to really move forward and start investing, unless they find somebody like you that already knows this stuff that they can partner with, which is actually a really viable thing to do a lot of times, is to partner with someone that really knows their stuff, because you learn so much through that process if you just go do free labor for them, and as well as maybe put capital up or something. It's an amazing way to do it. At the same time, don't always trust that partner either. Do your homework on that partner. There's a lot of those partners out there. They might know 10% more than you, and then you think that they know everything, and they don't. So there's a lot of people that don't, even though they sound like they do.
Right.
Like I'm full of crap right now, and you guys would never know it. But anyway, so
let me throw one last thing in. One of the most difficult things about buying notes right now is finding a good source for notes.
Okay.
So a lot of the hedge funds have kind of dried up. They're not, the banks aren't selling these huge pools anymore. So we still get some, and what we started doing a few years ago was mailing to private note holders. So if Tom loaned money to somebody and that person quit paying him, they would get a letter in the mail from me saying, hey, we pay cash for notes. And so we bought quite a few notes off of that marketing that we've done, because the institutional notes, the notes from Wells Fargo and Chase and B of A, kind of dried up. So we started going out to the private notes, like seller carryback and loans between friends and family.
So it's the same type of marketing stuff you would do to try to buy a single family home with mailers, pay-by-click marketing, all the other types of, and pulling that data. It may be harder to find those people through LLCs and that kind of stuff, but, you can do skip tracing and find these people. And, the more homework you can do on finding people that nobody else can find, the better deals you're going to get, because nobody else is talking to those people. So, Iris, what about yourself? To do the flips and the short-term rentals and the buy and holds, what are the different, resources and team members and people that you need for your business? Yeah, I know, like everybody. So,
okay, so who's a flipper in that, or who wants to be a flipper in the room?
Everybody's afraid. You guys are allowed to interact. It's okay. I promise.
Someone else wants to be a developer or note person.
Or landlord.
So yeah, who here is buying and holding properties? Let me see that. Okay. And who here is trying to flip but can't find anything right now because it's California and it's tough. Okay. So I mean, and who here is investing in notes and that type of stuff? Okay. Short-term rentals. Okay. Anything else? Any other construction industry people? Or okay, cool. This guy does everything. Come up here. We'll have a panel. No. So that's awesome. So what's your thought?
I mean, as far as flipping is concerned, to me the most important thing, definitely, and you've probably heard this over and over again, are just the relationships. I mean, the best deals I get are from referrals. And yes, it's highly competitive. It's hard to find a good deal. I'm not saying there aren't any, but it's hard to find a good deal on the MLS. They tend to get thin, and I'm sorry.
No problem.
They tend to get thin, and there's a lot of competition for them. And I hate it when I'm buying something on the MLS and I'm the winner of the big one. That just means I paid more than everybody else was willing to pay. So I don't like those deals. I like creating relationships. Yes, I've done mailers. It's not my main thing. More primarily through referral sources. And, I was just talking to these guys earlier. I just closed on a 9 unit in LA. And I have to tell you, that relationship went on for 10 years.
Oh, wow.
But it was an awesome deal. So, So some of these things, that some people you meet, you just never know. They may not be ready today. But, that was worth a Christmas card every season, right? And then when he was finally ready to sell, I was the first person he called. Or I should say his kids called us, right, when he was ready to sell. So the relationships are critical. Again, if you're going to go on the MLS, getting some good agents on your team, and I'm talking investor-friendly agents. Most agents, if they find out you're an investor, they're like, they don't want to put any lowball offers in for you. But I always tell investors, I'm like, why wouldn't you agents, why wouldn't you want to work with investors? We buy, 2-3 houses a month. That retail person you're trying to get a listing from will maybe sell once every 4 to 7 years. Mm-hmm. And so if you make some good relationships with some investors, you can get a lot of listings and a lot of commissions, right? Someone's going to get that commission.
Yeah.
So again, relationships, and then investor-friendly agents, are definitely helpful. And then in the flipping business, I guess it goes without saying, you have to have a good construction team. And my construction team is always ever flowing. I have this three property bench rule I use with my contractors, and that is every 3 properties. Okay, so the first time you use a contractor, they're really awesome. They love you. They want to please you. They get it done under budget and and on time. And then the second property that comes around, they get used to you. They know how you work, and so they're going to still do a good job. By the third one, it's always marginal. So every 3 properties, I bench a contractor. But that means you have to have several contacts in every field. And so, that way I get to keep a fresh, once I bench a contractor and they come back and they're on one of my properties, they're like ready to go again. So, it's just something that I've experienced that I realized that, just over time, this is something that I find that's really common. And then the other thing I want to share is, wow, this is really
just talk. It's messed up, so don't worry about it. Yeah,
and then as far as flipping is concerned, I don't know, have you guys heard of the contractor trifecta? Have you heard of this? Good, fast, and cheap. So just imagine like a triangle. So your contractor is good, fast, or cheap. And usually you get two of those. So they're good and fast, but they're not cheap, right? Or they're cheap and good, but they're not fast, right? So just, for new like flippers and stuff, I always try to give that, if you find someone who's good, fast, and cheap, you keep them, right? Give them as much work as possible. But again, I always like to tell people when they're getting bids from contractors, try to understand what that is, because I find that a lot of people fall into that. So that's just a little tip.
Yeah, we do the same thing on our stuff. It's like, the contractors, like I said, they're one of your most important team members. And, if you don't have that right level, you have to have that punch list thing, and they have to be very, very used to how you do that business, and making sure that you have proper funds control and lien releases and contracts in place. A lot of times contractors aren't good at managing their capital on, deals, and don't pay their subs right, or walk off a job, and then you got the lien on your property because, they didn't pay their subs, and their subs are putting the lien on your property. And it's not just like that with just contractors. Every one of your team members associated with real estate, when you're talking about CPAs, attorneys, I'd say financial planners, but they don't really fit. So, contractors, property managers, realtors, inspectors, appraisers, all of these different people have their quirks and have their skill sets and their weaknesses in different ways. So slowly understanding each team member and how you can get burned and how to massage that relationship and make sure that you're doing it right with that team member is key. Like, I don't go to one CPA and, out just in here in California. I have 3 or 4 of them, and I have them in different states as well. And I do consulting with them and get their opinion first, and have no problem paying them for financial or for that, planning advice, basically. Same thing with attorneys. You know how many different attorneys you meet that tell you 4,000 different answers to the same question? That, there's one of them happens to read case law on one subject that, changes the entire scenario, and all of a sudden everything's different. So the team members have their skill sets, and if you're inexperienced, it's hard to tell if they're really good or not, and you end up wasting a lot of money with people that don't have that skill set. So the referrals to the people that have already gone through that is going to be really key for you down the line, So that being said, Will, when you're doing the construction business and stuff, which is a whole nother animal, and the high-end flips, of course, is a whole nother animal than even what Iris is doing on, what more middle market in California, I would assume, right?
Yes.
That's a total different business strategy, and different, strategy to utilize. But how are you dealing with your contractors? You're the one managing these guys, and what are the different things you need to do to put together a high-end deal like that?
Well, my situation is unique in that I'm not just the investor, I'm also the contractor. So I have a distinct advantage over most of the people in the room because I have that. Starting out, I would say, and it doesn't matter if you're a flipper or buy and holder, there's really four items to a transaction. So you need sourcing deals, right? You need to find the deals. So you fund the deals, you need to fix, repair them, bring them up to rental for resale condition, and you need to sell them. If you're a buy and holder, that selling them turns into managing them. Okay? Those are the 4 aspects, whether you're a buy and holder or a flipper. Sourcing deals, there's a number of ways to do it. I like to cast a big net and have multiple hands in multiple cookie jars, because the more you're out there, the more chances you have of getting better deals. But it's a numbers game. Financing. I've been a huge fan of private money investing. Private money investors. I've built up tens of millions of dollars of private money that's at my disposal. It's a phone call away to me. That didn't come overnight. That was years and years and years of developing that. And with my track record, I'm able to get more and more. I have people that have invested with me that live in New Jersey and New York and never met me in person and sent me hundreds of thousands of dollars based on my performance history, my track record, and their knowledge of investigating me throughout the internet. So when you're starting out, it's really hard to have that. When I started out with friends and family. Mom and dad gave me some loans, aunt gave me a loan, and then it went from there. So I talked to my dentist, I talked to everybody and said, this is what I do. Don't be shy, you have to talk to people. And when I went out, one of my strategies was, I didn't come up and say, hey Bob, can I borrow $100,000 from you? I said, hey Bob, I've got this great opportunity for you. So I'm not asking for money, I'm offering you an opportunity. That was my strategy, and it still is to this day. Rehabbing it or fixing the property, you've got to have a good team member of contractors and subs. When I switched over from development and buying a whole lot of estate and I started flipping here, I acted as the general contractor, as owner builder, and in those days those were just lipstick flips, what we call them. So we've got the kitchen, baths, flooring, paint, landscaping, all the easy crap, put it back together and sell it. Now what I do is I've done $3-4 million homes, custom homes. Right now my market is anywhere between $1 and $2 million, which in my market in Sherman Oaks, Studio City, Atwater Village, those are entry level homes. Exactly, they're 2,000 to 3,000 square foot homes. They're not monsters. These require a lot more work to make the money up, and it takes a lot more time. So analyzing the deal is of vital importance. You wanted to ask about building your team. So of those 4 things, you've got to have the resources to get the acquisitions. You need your contractors. That is a trial and error, if you will. And I know that's not a fun answer to hear because you're going to go through the roller coaster ride of that emotional roller coaster of ups and downs. But it's what we all had to go through. Referrals help. If you're in Home Depot, Lowe's, you're there at 6:30 in the morning. Those are the good contractors. They're there early in the morning getting jobs done. Good way to talk to people and pick up a decent contractor. If they're in the painting department, they're wearing all white, they're painters. Pretty obvious.
Can I just add to that? Make sure you meet them inside, not the ones outside.
Yes. Very valid point. The ones inside actually buying the stuff.
That's awesome.
And then once you have your team, you've got to sell the property, so you've got to have a good agent on your team too. And you can use multiple agents for selling as well. My rule of thumb, my agent that sold my house or listed my house, they had to have a minimum of 15 years experience. The reason why? I want them to have a minimum of 2 to 3 real estate cycles that they've been through. Because if they haven't experienced ups and downs, then they just don't know what they're doing yet.
And it's interesting because both of you guys touched on the acquisition strategies here briefly, but a lot of people try to go into direct mail marketing or pay-by-click marketing or these other paid advertising things right away. And in reality, you can build such a gigantic base of deal flow through relationships first that is free. Like honestly, when I first got started, I was going to 4 networking events a week, every single week. I don't care if it's a lunch meeting or a night week. I had a sponsorship at Iris's club, and I was, constantly out there at all times. So if you can't talk to people, you better find somebody who can in your business. Otherwise, you're not going to be able to do this business because it's all relationships.
I'll add on to that too. When I was starting, it was driving for dollars, which is driving around your neighborhoods, and that does a multitude of things. You're trying to source your own deals. You're looking for that vacant house, the tall weeds in the front, boarded up, whatever. But it also allows you to learn that neighborhood, and you know all the streets, what's the good ones, what are the bad ones. If you're doing comps and you're trying to figure out the value of a house, which is also not just an art but a science, you got to know that a house on this side of the boulevard could be a different price from this one. But somebody that doesn't know that, just looking at a half a mile radius, you can get screwed there. So you have to really know your market. Driving for dollars does that for you. Third thing, when I'm driving for dollars, I go in every single open house. I don't care if it looked like a brand new house. I walked in there, I met the agent, told him who I was, told him what I was looking for, and they'd have my card, I'd take their card, and I'd get on their email list. Next time they had something that was a beater, I'd say, call me. Talk to everybody.
And that's key. I think a lot of people don't necessarily do their math right on some of these things, and you don't know what you can get a really good gauge of what a house price is by looking at the half mile comps and seeing what's out there.
but you won't know those intricacies of the difference in the $50,000 difference in pricing from one house to a next unless you analyze each one of those other comps. And then what I find a lot of investors doing is really not coming up with the right pricing on, they don't realize all their interest, their closing costs, all the other things that come up, the utilities and, everything else, the rehab overages, and sometimes they even forget their profit and they make too little of a profit, where you need to have a certain margin in certain areas to make sure if you're flipping. Same thing goes with buy and hold investing. You better know your numbers on, your taxes and insurance and repairs allowance and, vacancy allowances and property management and, turnover costs and all kinds of other things that can go into it, along with, long-term maintenance and, capital expenditure reserves and that kind of thing for holding rentals. So all of these things go into it, and most investors underestimate what their true costs are. And so it's really important to understand those numbers and get with people that know it really, really well, because after doing it for 10 years, you still find, there's a new cost that I didn't know about because some stupid thing came up with the city or some change happened or whatever it is. The last time I was doing one in California, I had to pay like $3,000 of school fees. And I was like, I just didn't know because I hadn't developed in California before and it wasn't in my budget and it was over by that. It's little things like that you don't realize unless you're in a specific market or niche or something. So
what would be like a typical deal for you guys?
I guess I'll start with that one.
What's a typical deal?
Oh, okay.
Yeah.
You can
one
give
thing
us one most recent one.
Sure. And one thing, before I say the specific deal, one of the things that we look for in note investing is there's several outcomes that we look for. One is monthly cash flow. Sometimes we'll buy a note from somebody, then we'll go and negotiate with them, and we might buy the note for $10 or $15 or $20,000, and we get $300 or $400 or $500 a month coming in for 15 years on that. So that monthly cash flow is a nice advantage. Mm-hmm. Sometimes we end up getting a lump sum. We'll buy a note, and instead of them, they owe us $100,000. We might have bought it for $20,000. We'll go to them and say, can you pay us $50,000 and pay the note off in full? And it's a big discount to them. They owed $100,000. Now they're just going to owe $50,000, and we had bought it for $20,000. So we make $30,000 on it. Sometimes we'll take a note and we did one in San Jose recently. I'll use that as an example. We bought the note for a little bit over $30,000. It was the note was already, the first mortgage was foreclosing on a second mortgage. We bought the second mortgage, even though the first was foreclosing on it. We reinstated the first, and then we started foreclosure on that property ourselves. We bought the loan for $30,000. The first mortgage was like $190,000, and then we had another $25,000 or so of fees, legal expenses and payments on the first mortgage, things like that. So we're into it for like $240,000 or somewhere in that neighborhood. Property is worth $450,000. So we took it to trustee sale. They owed us about $230,000. We set the opening bid at $105,000. So when you're doing a foreclosure, you can tell the foreclosure company if you want to drop the bid. Instead of us asking for the full amount owed, we dropped it so someone would be interested in it. And sure enough, somebody paid us $120,000 for it. So we doubled our money in 9 months. So we had something like, $50-something thousand invested in it. We collected $120,000. So that was a chunk of money that we got. It's kind of like flipping a house, but we got a quick, 9-month lump sum payoff. So if we get to my slides later, that's one of the deals in my slides.
And this is why he likes seconds a lot, is because you can get them at giant discounts, but you have to make sure you understand the underlying firsts and make sure you know all the intricacies of these things and how to reinstate the first, or make sure, you're protected and how to protect yourself. But it's amazing the kind of returns you can get because, if someone's paying $500 a month on a $100,000 loan or something like that, and Gerald buys it for $15,000 because it doesn't have a lot of equity, and he says, fine, pay me $250 a month or $300 a month. His return on investment is awesome. Yeah. And he's just great, no problem. And that's win-win for everybody involved. And then he doesn't even have to discount the $100,000 a lot of times. So there's cool strategies to use in doing this. With the notes, when you learn those strategies, like I just did a loan where, or a deal where I bought a property from an investor with seller financing with a 10-year balloon on it at 5% amortized over 30 years. And I bought it for $66,000 with $2,000 down. And I went and sold it for $90,000, literally like before I even closed escrow on it, and did a double close and resold it with seller financing with $10,000 down and seller financing at basically the exact same interest rate for a 10-year term with a 30-year amortization. And I made a spread and made a little bit of money up front. And that was a small deal, of course, but at the same time, these are the strategies you can use by using paper, because you can go and provide financing to people that you may not have ever been able to do in the past. So it's kind of cool.
I'm flipping notes.
yeah, I know, right? So, what about you, Iris? What was your last deal?
Okay, well, let's see. I just got one today. So a typical deal?
Yeah, typical deal, or yeah.
So, I kind of wanted to, I work with a lot of wholesalers as well, relationships, right? So people that actually do go out there and do the driving for dollars and marketing and stuff like that. But I like to tell wholesalers, generally what I'm looking for, so we're not wasting each other's time. So I tell them, as a general rule of thumb, if the takeout price is, let's say, between $3 and $4.50, I need to see at least $100,000 spread. So meaning if it's going out, the ARV, everyone knows what ARV is, right? After repair value is $450, then I need to be buying it for $350 or so. If you're telling me, if you're trying to wholesale that thing to me for $400, I'm not even going to look at it, right? And then it goes up from there. So from $450 to like $600, I need to see at least a minimum $150,000 spread. And then above that, from $600,000 to $800,000 ARV, I need to see a $200,000 spread. I don't do the high-end stuff because that's expensive for me, but and so I like to do more of the lower-end stuff. And there's more buyers for that as well. But I think you have to be a market, so that's really cool. So that, as a general rule, that is what I'm looking for. So typical deal today is in Buena Park, the takeout price, and earlier you mentioned, or I think Will, you mentioned, it's really critical as a flipper that you know your numbers. Probably the most important skill is to determine your ARV, not guess your ARV, but know your ARV, because everything comes down from...
And your rehab costs.
And your costs, of course, right. And then you just back out to determine what your offer price is, right? So, that's like one of the biggest mistakes that I see a lot of investors doing. They get so excited because they're even in the running, right? And maybe they get a response back from an agent, and they tighten up their numbers so much and try to stretch the ARV. And I don't know if you've noticed, but the market's kind of stalled right now. So stuff that I bought earlier or in the middle of last year that are on the market now, are lower prices than what I was anticipating. So, it's really hypercritical. And if you start, inching in your profits, one cycle term of like, let's say 5% on a $600,000 house is $30,000, right? If you only make your margin that much, it's gone. In the matter of months.
And that's really important in this kind of a market to make sure if you're looking at flipping or holding or whatever it is, and you want to get built-in equity, you better make sure that you have your downside risk of the market correction coming in, especially on a flip scenario. And, the way you price these things out is you go from, like she says, your market value, and then a lot of times you don't know your rehab yet. So you're like, what is my market value and all my costs, and what does my margin have to be first? And back into, okay, here's my price before rehab. Then you go check out your rehab and say, okay, what is my price now? So now if you know that number, you can now go tell a homeowner, hey, it's X amount minus whatever my rehab is, but I'm telling you, normally on this kind of a house, my rehab's X amount, so you don't waste a lot of time and with a bunch of people that know how to do that.
And I'm honest with the homeowners, when I'm in front of them, I'm like, this is what I do for a living, so I have to have a profit. I can't. I'm like, do you work for free? Well, I don't work for free. And so long as you establish that understanding, they will respect you. Even though, that number is coming in lower. They see your numbers and they're like, I'm going to make $200,000. No, let me break it down for you, right? This is how much it's going to cost, and, I need to have a profit margin otherwise, because I need to feed my kids, right? And people understand that. And remember, when you're dealing directly with the homeowner, I'm not, there was a statistic I saw, 95% of people will sell on the MLS. It's the way people most know. But it's that 5% as, let's say, a wholesaler or a flipper when I'm meeting directly with sellers. It's that 5% of people I'm looking for that have a need, that don't want to show their property or need their money right away. That's where we as investors can really help those people. So it's your duty as an investor to find those people. And guess what? Those people are waiting for you. So never be afraid to write that offer and stay true to your number. So anyway, back to your question. Today, my typical deal, 450 was the contract. My conservative ARV is 600, so right there, $150,000 spread, but I think I might be able to, if the market goes better in the spring, maybe sell it for 620, 630. So that's just gravy on the back end. So
What does a rehab look like on something like that?
that's probably going to be a $60,000 rehab.
Okay.
So it's your bread and butter house, 3-2, 1,600 square feet. That's a bread and butter.
You think after all costs, you're probably above a 10% margin on something like that?
We'll
pretty
see.
close.
Hopefully.
Yeah,
Well,
yeah.
It depends on the market.
Right,
Not
what
only
happens?
has prices stalled, but it's been taking longer to sell too. So you got when you have hard money on a deal that you're working on, every month that goes by, that's $4,000, $5,000, $6,000. Will's case, $8,000, maybe $10,000 payment a month, and that can work into your profit very quickly. So
And that hurts too. I mean, when you look at that, you start to pay attention to your efficiencies on, I closed escrow. When is my rehab starting? When am I getting that going right away? And so many times it's super easy to say, well, I need my inspection. I need this done, and not have all that stuff done by the time you close or right away after closing. It could take a month sometimes to get something started with utility inspections and, city inspections and all that kind of stuff. And that's not doing development, So.
We have a question right here.
Yeah.
My question was for Iris. Do you have plan A, B, in case the market does turn?
Yes. So I have had situations where we're back at market and my profit just wasn't there. Like it wasn't worth flipping it or selling it. So we've kept those and then done short-term rentals, to expand, and then. That allows you to get a good cash flow, and then when the market returns, if I want to, Clyde, then I can sell it. if there's enough.
It takes your flow.
Yeah, so I have done that. I mean, worst case scenario, I'll just sell at break even point. But I don't like losing money, so if I have to, I will keep it and rent it. And if I have to, Airbnb it or do a short-term rental, so I need higher rents. So.
That's great. What was the source for that apartment?
This one was actually a referral. Erin Norris from the Norris Group said, there's a gal, and I know you do Orange County, so can you help her? And so, I mean, again, it's just
relationships.
Yes, relationships. So
That's great.
So my typical deal, when I sold last summer, I bought it. It was a 2-bedroom, 1-bath, small little house, like 700 or 800 square feet, on a decent sized lot located Sherman Oaks, which is in the San Fernando Valley. And this is a very high-end area. There are multi-million-dollar homes in and around this neighborhood. It's right off of Ventura Boulevard, which is the Strip. And I bought that for $735,000. It took $350,000 to knock that house down and rebuild a 2-story, 2,300 square foot home. We also knocked down the attached garage in the back and put the new 2-car garage attached up in the front. Took us, I believe it was about 10 months to do that project, and we ended up selling it for $1.56. Sold it in July, broke records on that particular house. I have one right across the boulevard, right around the corner, very similar numbers. Acquisition was a little higher on that one. That one also had a pool, so I had some expense there. I think we spent $450 on that one, and I missed the market by about a month and a half, and it's at DOMs were going up, buyers got standstill. We're right at the midterm elections. We had holidays, which the seasonal is always slower, so I just missed the timing. If we could have got that done a little bit quicker, I would have nailed it. In that particular case, it didn't work out so well. So those are my average deals. We're in between 1.3 and 1.8 million typically on our sales, and I'm usually trying to buy at 600,000 to 800,000. I have a couple deals that I have on hand right now we're working on. I bought at 865. Those I expect 1.75 to $2 million.
So how much are you putting in?
They're anywhere from 300 to 500,000 to develop the property, and they take 9 to 12 months because you got permits and you got time waiting on that. And you have inspections and everything else, whereas the lipstick flips and you get in there, you got the kitchen and get in there and get out of there, turn it and burn it.
What are the differences in materials and that kind of cost from like maybe one of the middle range rehabs versus some of the high end stuff that you're dealing with? Because that gauge and that difference on is this really that high end of a house or where do I go with materials is a hard gauge to do for people. So.
It is, but I've always created a niche, and I think it's really important for people if you're starting out. You need to identify what your niche is and go after it. And when the market changes, you've got to change with it. Because if you don't, you're going to get left behind. I've changed my strategy multiple times over the last 15 plus years. And had I not, I wouldn't be sitting here in front of you today. So it is imperative that you change your strategy or change your niche as the market changes. So back in 2010 to 2012, all of my acquisitions came directly from asset managers and top REO brothers. I go direct, they never hit the MLS, they feed them to me, I buy them, close them, fix them, sell them, turn them and burn them. And it was easy to sell those. Then the market started to change because the banks changed their rules. And then they couldn't sell them to me without putting them on the MLS. So then I had my top agents. They'd get the listing, they'd tell me it's coming, we'd have the offer written, ready to go the day it listed, they'd send in their offer, hopefully nothing else came in, they'd try and convince the bank to take it, they'd take it, it'd be mine. Then the rules changed again, I had to change my strategy again. I saw that I was going to have to start doing what everyone else was doing, buying off the MLS, unless you're a direct marketer, which I've never been. I'm a huge fan of it, I've just never done it, so I can't speak intelligently about it.
Not easy at all. It's
not an easy thing, and that's a huge numbers game, and it's definitely an investment. But I saw the writing on the wall, and I knew I had to start competing with MLS. So that went for a while, and I started going up in the upper echelon price points. That's when I started doing $1, $2, $3, $4 million homes, because I eliminated a lot of my competition, because not all of you can compete there. Then the market turned again, and trying to do those was huge risk, and I had some huge home runs. I made $1 million on one flip. I also lost $250,000 on one flip. So it is a risk versus reward thing there.
It's a bad day.
That was a bad day. So the thing about that is, as I explained earlier, my big thing on how I funded all these things is private money. And this particular house was the first time I took a hard money loan. And no offense to hard money lenders, because I think they provide a valuable service, but I had a hard money loan with payments on that. And then I had private money seconds. And when it was all said and done, there wasn't enough money to pay the private money seconds. So I signed on the dotted line, William Bernard's going to pay you. I promise I'm going to pay you. So I did. So we sold the house, we took their notes, and basically said, hey, I'm going to flip another house and I'll make payments to you. So I went out, flipped the house, and got them all paid off. I could have just filed BK that said, sorry, Mr. and Mrs. Investor, but that would ruin my reputation, and all of my lenders would no longer be lending to me. So I took that $250 hit, ate it, and now all of my lenders love me even more because they know they can just write that check.
That's so key for building the trust there with your investors. If you don't take the hit for your investors when something happens, I mean, you're going to lose them forever, and they're a resource to be able to build those tools in the future. So you have to take those hits as many times as you can for the people, especially when they're private investors, because most of them are not sophisticated, and you have to realize they're trading their time for that money. That's hours of their life you lose if you lose that money. So if you're able to go through and save it in any way, realize you can make it back as long as you don't quit. So and that is the biggest, most powerful resource you can have. And how long did it take you to raise money doing that, Will? And what were the activities you did when you were raising that? Trying to start to raise capital. No. So when you started raising capital, and how did you start to do that and get that exposure out there, other than just private relationships and networking, which is obviously important? What did you do for marketing? What did you do to try to bring those investors in, to bring that capital source to that level?
Word of mouth. So I attended events like this and spoke to people. There's a lot of private money lenders in here, and you can never judge a book by its cover. I was talking to a gentleman at one of Iris's clubs probably 10 years ago. And this guy came in with a white t-shirt, with a little hole right here, and flip-flops, and the guy was worth like $15 million. So you never know who has money. The point is you talk to everyone. I did that. I did a lot of Bigger Pockets. I don't know if you're all familiar with Bigger Pockets. Who's a Bigger Pockets member? All right, fellow brother. I've been a long time Bigger Pockets member, so I started making posts there, and I'm one of the top contributors on Bigger Pockets, one of the original members there. I have got a lot of private investors from Bigger Pockets, so getting out there and giving away my information, my experiences, and talking about what I've done in the past has allowed me to gain more exposure simply by talking about what I've done, whether it was a success story or whether it was a failure. And I think a lot of the people that have come to me, they came to me because they appreciated that I was open about my failures. And they said, wow, this guy failed at this. He recognized why he failed or how he failed, and he still persisted through that to go on to the next one.
Just with any business, it's the failures and getting up, so.
I just think that's absolutely so fabulous and important. I mean, it scares me when I meet investors, because I invest with other investors as well. But it scares me when people come up with, stellar track record, can't make a mistake. I'm like, oh man, it's just a matter of time. But, what's more important to me is if you hit those challenges and something happened, I want to know how you handled that. Because that actually builds more trust.
Right.
And, just like it goes without saying, well, like you said, I mean, your investors are probably one of your most important commodities. And
anybody that's trying to borrow money or from you and says that they've never lost money on the deal is either not experienced or doesn't, or they're lying. Yeah, one of the two. So, and when you raise money from investors, Iris, what do you do? How do you structure it, and how do you protect them when you're raising the money?
I just wanted to mention, some of my biggest investors will be in the most unconventional places that you would not. I mean, you would. Obviously I have investors because I have a club and people, know me from my community. And so there's, that trust already, you provide education and things like that. But some of my biggest investors came from unlikely places like, not in the real estate community, is I guess what I'm trying to get to. And so one of my heaviest investors I met in a Tai Chi class. And I would just go to Tai Chi because I could. I was a real estate investor, so every morning I would go, and I was the youngest person in this class. And all these people would be like, who is this girl? Why isn't she working, right? And then eventually, I just kept at it. I found it really,
relaxing,
moving, meditation. And then next thing you know, I started getting invited to their lunches, and then they started getting curious, what is it that you do? And it's just that, again, that relationship building. And then so I never asked for money. They just got interested because they heard that I did real estate, and they're like, I want to get involved. So it just starts out with that first deal. You let them in, give them the opportunity, and then they all of a sudden, your first investor may just, may be willing to invest $30,000, and by your second investment, they have millions. And you're like, what? So again, never judge a book by its cover, and it's an ongoing relationship. And the one thing I learned about investors, if you find someone with, some money, guess what? They have other friends with a lot of money. And, that word of mouth is just golden. And again, if you're starting out, don't discount all those other places that you may go. Another big investor that I use quite often, met him at a dive bar. Because I like having drinks. Yeah, it was a dive bar in Tustin. They were involved in oil. They're like, yeah, we'll do some real estate. I'm like, oh, okay. And I guess I had gone enough that there was enough drink. But again, smart investors, you've got to show them what they're investing in, and that's the other thing that I don't like it when people just come up and throw money at me. I'm like, do you understand what you're investing in? You need to understand first before I even take anything. You need
it's
to
a huge risk, yeah.
And what you're not, there's no 100% guarantee in any investment. So.
I think that's a huge point because just because someone has money doesn't mean you take their money. There are some crazy ass people out there that you need to fire as an investor because they don't know like what they're doing. I got yelled at for paying somebody off after they signed the trustee release and sent it back to the closing attorney and got the check in the mail because his money wasn't invested consistently. Like you get these types that you just don't understand, and you're like, well, wait a minute, okay, maybe you shouldn't be investing now. You didn't understand what I thought you understood, and stuff like that happens. And with the relationships, it starts to snowball. In the beginning, same thing. I'm like, I didn't know anybody with $30,000. I'm like, my friends are broke. Who do I know? Like, and after a while, slowly getting involved over a long period of time with more and more people and going to these clubs. And, one of my largest investors just introduced me to his mentor that, this guy has millions with me, and his mentor has like $35 million and runs multiple businesses. And I just got to go have lunch with this guy. And, there was a couple of compliance things. This was maybe a year ago. And he's like, hey, get a couple of these things cleaned up in these other states and you get your shit together and I'll invest with you. That was his words. I was like, all right, cool. That sounds great. I'll get my shit together, but you start to develop these relationships and the rapport with these different people that have the relationships, and they build the trust with them over time. And, you do what you're supposed to do and take care of those items, or you take care of like what the requirements are, and you come to them in the right fashion with the right level of respect and the right due diligence on those deals. And they will really come to think about my investor, my biggest investor, how his friends. The $35 million guy has way bigger friends, so it's kind of interesting when you start developing those relationships. Gerald, how do you raise your capital, and how do you go about like protecting your investors when you utilize their capital?
Well, listening to these guys talk, it's very similar. One of my favorite long-term investors, I went to a Jack Miller event up in Reno probably 7 or 8 years ago, and I was sitting at one of these long tables, and he was, a couple chairs over, and we started talking and visiting. And, you go to these events, you don't know if that guy's never done a deal and he's broke, or he's done thousands of deals and he's got $10 million. So we just became friends, and we had some common interest, and it took about 3 years. I explained to him what I did. And finally, after us kind of bumping into each other and going to events together and hanging out, he finally said, okay, Gerald, you know what? I've got $300,000 sitting in this account doing nothing. I'll put that with you, So that's one way of doing it.
And there's millions of people that have $300,000 in their account that are doing nothing with it too. Like, it's amazing how many people are doing nothing with their money that have a big chunk there, because it comes. You have to have that education to be able to invest. So.
Yeah. Another person that is one of my long-term investors. I was getting my real estate license probably 8 or 9 years ago, and I went to one of those crash courses on a Saturday and Sunday, and the test was on Monday. And so we're sitting at the table with his wife. Her name was Yolanda, and we were talking, and she said, "Oh yeah, my husband does some real estate." And so later on, she introduces me to her husband, and he gave me $90,000. Right now, he probably has close to $2 million with us.
Oh, wow.
So it went from the first deal was $90,000, and now it's 1.7 million, I think, right now. But then somewhere in that neighborhood. One of my friends, he knows that I raise capital, and he called me up and said, "Gerald, I got somebody that has $500,000 and he wants to invest." And so I said, I'll pay you a 2% fee to bring me that guy. And so I paid him. I wrote him a check for $10,000, but he brought that investor to me and gave me $500,000, which was not a bad deal.
It's great.
And I have two ways of investing. We do either joint ventures, where we do a 60-40 split. So the investor gets 60%, I get 40%. They put up all the money. And then the other way I do is with a fixed interest rate. It could be anywhere from 7%, 9%, 10%, something like that.
Those are always better. You get the upside potential.
But some of my investors, they're more savvy, and they're real estate people, and they'd rather take the risk and get the upside.
Right.
And some people are, CPAs or dentists or whatever, and they just prefer, In fact, one of my investors, my brother actually, I offered him like 7%. He said, "Can you afford that?" Because he's got money in a CD making 2.5%, or whatever, So he was kind of, questioning.
It's funny, the rates you pay is all relative. I mean, to the resources you have, to the different investors you've already developed over time. I mean, if I have, all unlimited money at 10%, why would I ever take a new investor at 10% ever again? They'd always be pushed down, you know? And so, it's a matter of those resources over time. So as you develop those resources, your interest rates will go down, and your resources go up, and in reality it's crazy how powerful you can get by having those rates lower and constantly developing new capital sources to do that. And then it's funny, once you actually don't need the money, then the banks come out of the woodworks and they're like, yeah, we'll give you all the money you need now that you don't need it, but when you're broke or you don't have a lot of money or you're just scratching by with not a good tax return, they're like, yeah, get out of here, it's crickets, but you want to be careful about those banks. Don't ever rely on them. That's the hardest part about this, is always have those other secondary resources. So 2008 happens and you're not relying on banks like I did again and losing your shirt. So I was doing a rate and turn strategy where we would buy them, renovate them, sell and resell them to other investors that were immediately refinancing and paying us off when the lending market stopped completely and you realize you have no income coming in and you're done. So, these are the things that happen when you're investing, and you're watching out for that market. After you take that first hit, you look at the market a lot, so.
Yeah. I have about a dozen investors that I work with, and typically they want to roll their money back in. Instead of me paying them off, they're like, well, do you have anything else I can put the money into? Because they don't want the money back. Mm-hmm. They want to keep it working. And one of the nice things about the second loan business that we do, the HELOCs that we buy, we have 10 houses right now that 9 of them we owned the second mortgage and we foreclosed on the property, and we took the property subject to the first mortgage. So we kept the first current, and we've been making payments on that first mortgage all along, and the interest rates are all below 4%. So, in fact, I'm closing on a deal. We got a property going to trustee sale Monday in Carlsbad, and it's a house that's worth about $850. The first mortgage is $650. We had a second mortgage on it, and it's a fixed rate at 2% for the life of the loan. So, awesome. I've already worked out a deal with the homeowner. I'm giving him cash for keys. He's not going to fight me. He's going to allow me to just keep making payments on that loan. And but it's you can't get that kind of financing anywhere else.
Yeah,
and the reason it's so low is because he did a modification. He got behind on his payments 4 or 5 years ago. He worked with the bank, and they dropped his payment to something that was affordable to him, and I'm able to take over that modification. I can't assume it, but I can basically take it over. I can't get it in my name. I can't change the loan from his name to my name, but I just keep mailing the check in every month, and the bank accepts it.
And how do you convince him to do that on something like that, which, you're saving his credit, you're going to keep making the payments? Do you show him that you're making those payments, or he doesn't care, or how does that work?
He has access. The loan's with Aquin.
Okay.
So he can log in. He has a password and log in. He can go and check and see if I'm making the payments.
Cool.
And I paid him a nice chunk of money to cooperate with me, cash for keys.
Okay. So
I gave him some walking away money.
Okay.
And he needed it. He was broke. He hadn't worked in a couple of years, and he was just in a bad situation.
It's interesting what you could do. I mean, it's funny because you buying that deal is not necessarily about price a lot of times. It's about how you can solve a problem for that other person. So if you can find a way to solve a problem, that's how you get those deals. And it's like, what is their problem? And it's about finding that pain point and what their issue is. If it's not working for 2 years and needing money right now, or if it's, hey, I'm about to lose this house tomorrow or the next 2 days and everything's going to be ruined. I'm going to never be able to, and being able to catch them up and make the first current and stuff like that can be, hugely beneficial to a lot of people that are in very negative situations. So.
Well, when I first met him, I bought his loan about, maybe 6 months ago, and I went and knocked on his door and talked to him and, set up an appointment. And he was $55,000 delinquent on his first mortgage. So I had to write a check for $55,000 to bring the first current. So that's a pretty good chunk of money, to do that. So when you're note investing, you have to be prepared to, it's not just the price of the note. You don't just buy a note for $20,000 and you're done. You might have to pay bankruptcy fee, attorney fees, first mortgages, things like that. There's other expenses involved in it.
It's funny, in the very beginning, Gerald actually, I worked with Gerald on a deal where an associate of mine, her and her family took out a $100,000 second on a property and lent it to a guy at the top of the market that was trying to flip land on the way to Vegas with no deed of trust, no security, no collateral, and he borrowed multiple investors' money on the same piece of collateral, which is securities issues with all of that. But he didn't know what he was doing, and he was making $10,000 payments, for a while, and stopped completely, and to try to pay it off and all this stuff, and it was a big mess. And they ended up at the end of the day, they ended up losing, they ended up being stuck with this $100,000 loan that they didn't get paid back out of a much bigger loan. And they had taken out this 100 on their house for that piece of it, and they had that left there. And it was interesting because the girl that was doing this put her head in the sand because she's like, I don't know what to do. The second mortgage is calling me and trying to find me. I don't know what's happening. And so she brought it to me, and I look at the paperwork, and it says the Lemoyne Group. And it was Gerald, and I'm like, he owns the second. You guys have no idea how lucky you are right now that I know this guy. And ended up, cashing it out for 30. He probably bought it for 10 and made a good profit or something. But, a $100,000 loan for 30, 35 was like a home run for them. They were the happiest people on the planet. They were able to handle that kind of a loss and not lose their homeowner, their house from something like that. And these are the things, it's like, how do you work out these relationships? And it's amazing how this can work sometimes through those relationships. So
I had put them in foreclosure. I had filed an NOD.
Yeah, because they weren't paying attention.
There's a friend. We handled it, and it was all taken care of, and it was just a mistake. It was like them trying to make money, and they got duped, and you learn those types of lessons the hard way. And luckily, I was there to help, and Gerald was there to help that situation, and luckily he got the note. So you learn those types of things the hard way. And I've taken hits like this. You learn. Everybody takes these types of hits. You make one mistake and you can lose a lot of money on this, and that's why it's important to have those attorneys and different professionals reviewing your stuff if you're not sure what to do, because if you don't know how to protect yourself on the collateral, then you got issues that you have to deal with, right? So
I think that's a really good point. I'm sorry. I don't mean that as far as the collateral is concerned, this is another big mistake that I see lenders or investors do. They want to invest in maybe someone's flip, but they don't know the collateral that they need to have. Mm-hmm. So I think it's, and so when I get private investors, there's always a deed of trust. There's only one investor on that deed of trust. And there's always a note, and it's always done through escrow. So these are just like, I've seen nightmares where people have come back to me and just be like, they said I was going to be the second or even the first, and it turns out they're the fifth or the sixth, or nothing even recorded. Mm-hmm. So I think it's if you're going to, let's say, do a note or create a note or be someone's investor or private money, you need to also educate yourself on what are the documents that need to be filed and recorded and in escrow to protect
how are you protected, and can you go through and if you had to foreclose, can you take back the property, finish it, and then get all your money back? That's the whole idea. If you're buying a note, can you foreclose on it, and are you happy with the current payments? And if you had to foreclose, can you foreclose and get all your money back, and will you be happy with that situation if you had to do that? So that's basically the key with any kind of investing, is that aspect. So, Will, you talked a lot about, bigger pockets and the resource there, and I think that's an awesome education source. What other types of, blogs or educational content or other kind of resources do you know about that would be good for investors to kind of know about or watch and learn themselves? Or maybe it's a specific group. I know the Norris Group has a good one, good education source. Is there anything else you can think of that you utilize?
Other than what you just named, not really. I mean, Bigger Pockets was a great stepping stone.
Yeah, you use that constantly. So
it's awesome. For me now, I'm an educator on there, but Even today, I still learn new things. So if you're not learning, then you're dead.
Okay. And what about books or anything like that, or CDs you listen to, or any of that kind of stuff? Or you're like, no, I got kids.
Books. I'm not a huge book reader, but I think that they're very valuable. And you can go to the library and get books for free, so you can go online or whatnot. So reading is key. Understanding other people's experiences.
You mean you don't need to do the $16,000 boot camp?
You don't need to do that. Definitely not.
Nice.
Scam artists.
There are some good stuff out there, but yeah.
There's good stuff out there, but these guys that are pitching their stuff in their boot camps,
yeah.
I mean, if they make it sound so easy. Oh, just go out here, you can go and buy this house and turn around and flip it, and you can make $40,000 with none of your own money.
You guys
just run to the back of the room for $99.95. You can buy my CD package. The thing is they're selling those things because they can't do what I'm doing. It's easy for them to sell that package to you.
Than Merrill has a really great course where he's looking for unique people on the internet right now that want to be flippers and buy and holders for his program for the weekend. So
yeah, and what's unique about them is they have a heartbeat.
Yeah.
That's all it is. All that and money. It's the only requirement to be there.
Iris, what about yourself? What kind of education do you keep up on and keep your game up?
I think it's really important to educate yourself. I mean, there are, other than the gurus you're talking about that have the big coaching, $50,000, $60,000 programs, there's a lot of great teachers out there that can definitely shorten your learning curve. Like, Clyde Wilson's in the room. He has great education and affordable education. And I just find that a lot of the classes I take, I'm not paying thousands of dollars, but I'm getting excellent education, like Gary Johnston's, Peter Fortunato's, the old guys, sorry, the old guys that are very, very experienced, and have a lot of knowledge to dispel, and, going to these events, in addition to that, is just the people in the room, like Gerald said, he was at a Jack Miller seminar, and he met one of his biggest investors just in the room. He was in the class. So I mean, the education is really important. And then if I can do a self plug, I do a 60-day challenge.
It's an awesome thing.
And the whole thing. I mean, it's not for everyone, but I do find owning a real estate home. I see people. Someone mentioned that coming in and out of these rooms, and they never invest in anything because either they have fear or they have analysis paralysis. And so I created this program where you come into my den and I kick your ass for 60 days.
Yes, you do.
Yeah. But, my whole thing is I'm not here to teach you everything about real estate. I'm here to hold you accountable and make you do the things you need to do where you're going to learn the most. Like all the learning is in the doing. So writing the offers and getting in front of people, creating relationships, learning how to negotiate, writing the offers, and getting to your ARVs. So those are the things that I realize is what people need to do, especially when they're starting out, because everyone tells you to do that, but no one does it because no one's making you do it. So if you give me 60 days and I'm going to make you do it, and you're going to find, amazing results just in what you learn by doing. So that's something that I have. It's called the 60-day challenge.
That's like basically you're hiring a trainer to get your butt to the gym. Instead, is what you're doing in that case. To send somebody's going to go there and say, right, offer after offer after offer after offer. This is what we're going to do. We're going to run through the motions of what you have to do every day to get this, get a deal. To get their first one, because so many people are like, I don't know what to do. I haven't gotten a deal.
They take that big class, and then on Monday they're like, what do I do?
There's no action, right? There's no action. So you literally, 90% of this is consistent, slow action steps. Like, I don't care if it's a half an hour a day. If you spend a half an hour a day, that's a half an hour someone else isn't doing, and you'll find that deal if you spend a half an hour a day every single day for a month or 2 months doing it. If you found a deal that you're going to make $60,000 on a $600,000 flip twice a year, is that going to change your life? Absolutely. It's like, there's your retirement right there. And as long as you don't flip them, right, Clyde? So.
But, the last thing I want to add to that is, it's really great that you guys come to meetings like this. Like, I learned
Yeah.
everything in real estate by going to real estate clubs. They didn't have the Dan Merrills, they didn't have the Trump universities when I learned how to do real estate. But I learned by going to clubs, meeting people, and then taking really quality classes. I mean, I did invest, in some classes. And I also paid the $30,000 boot camps just to realize
I
that
did too.
that was kind of a waste of money.
Yeah.
When I was getting quality education and these lower price classes and meeting quality people. So that's so going to the clubs. There's so many niches in real estate. They all make money. It all works. But do you work it? I mean, you can make money in any of these niches, but you got to hang in there and just stick to it and work it.
Yeah, I'd like to talk about education a minute. Clyde asked me to plug this book. That Clyde he has maybe 5 or 10 copies of that. It's Invest in Debt by a guy named Jimmy Napier, who was Clyde's mentor, right? Clyde, basically taught Clyde how to invest, and Clyde's become my mentor. And so it's a great book. I've used it a lot in my note investing business. He mentioned Gary Johnston, and Gary has an event coming up end of February. It's called The Next Step, and I'm actually going to speak about notes for about 3 hours with Gary and Clyde. It's here in town. It's the Courtyard Marriott on MacArthur, I think.
Santa Ana, is that right?
Santa Ana,
I'll be
down
there.
off the 55 near Dyer Road. So that's coming up. And if you go to Gary's website, GaryJohnston.com, so there's a T in there, Johnston. And she's got a bunch of cards there. See, Joanna, after that. And, for me, the first person I heard speak about real estate was Ward Hannigan. And he was doing a foreclosure class at the Huntington Hotel, I think it was called, over by Belterra.
Yeah.
And I went on, I don't know where I found his name. I don't know if it was on a newspaper or
That's way better.
well, no, I mean, seriously, it was probably 2003. So it was about, 16 years ago. And I was thinking about, quitting my job and what am I going to do to make a living, And, what I really wanted to do was the home market was pretty expensive back then. The home prices were going up. And I thought, maybe I can buy a foreclosure because I wanted to buy a house. I had met Megan and, we were talking about getting married and I was living in an apartment. I had sold my house in Colorado and was renting here until I could find a place to live. And so I went there strictly for the purpose of buying a cheap house. I wanted to buy a foreclosure. And sitting there listening to Ward, he motivated me so much that I thought, I could probably make a living at this. And that was, here I am, 15 years later doing this full time and have done it, full time for quite a while. So I went and took Ward's course and it seemed expensive at the time. It was like $3,500 or something like that. On door knocking and buying at the trustee sale. And, one of the first deals I did was a house over off of I-10 and like Crenshaw. And I was out door knocking and I bought this house from this lady. We were talking about it then, and she's the lady that I went and found the apartment for, and she's dead now. Mm-hmm. And we flipped it and made $100,000 on it. I bought it for X dollars, and we spent a lot on the rehab, like $125,000, and we ended up selling it for like $700,000. And this was 2007, and this was right when the market was turning. My realtor calls me up and said, "Gerald, we better dump this house. We better get out of it." And I had it listed for like $800,000, so we cut $100,000 off of it, and we sold it. Went into escrow pretty quickly, and we still made $100,000 on it. So, but the realtor was savvy enough, like you said, the recycling, to say, hey, something's going on here. Things are falling out of escrow right and left, like that. So we better get rid of this thing. We did. And then I took Bruce Norris's boot camp, and I spent another $3,000 or $4,000. But it saved me a lot of money because if I hadn't learned what Bruce teaches, then I would have, paid too much for the house or underestimated the rehab or not know how to sell it or just a whole variety of things that, a 3-day class with Bruce was well worth it. So things like that and events, hundreds of these kinds of events, weekend seminars, things like that, Jack Miller, John Shaw, Peter Fortunato, all those kinds of events have taught me a lot.
I spent $16,000 on Nouveau Riche education, and it's really funny because the whole idea is you go sell. It costs you $16,000, but if you sell it to somebody else, you can make $8,000. So, but you get for that you get classes in Arizona for basically 4 weeks out of the year for 2 total years for $16,000, and it's a week at a time from 8 a.m. till 10 p.m. on every topic you can possibly think of as related to real estate. You can retake it the second year basically, and so the education was really, really valuable. I personally, for me, I thought it was great. I think it was probably me a little bit gullible, thinking I knew everything about real estate after leading into that course, that one course, and it's like college where you get a base level knowledge and really don't know anything yet until you actually start doing it. But yeah, until you're out there and losing money, I can't do that, and learning those lessons. But in reality, 95% of people were wasting their money doing that because they weren't actually going to take action. I actually was just like, I can't do taxes and audit anymore for a CPA firm. I'm going to shoot myself. This is crazy. And that's what motivated me to get out of it. But, in reality, these education courses can be really valuable. I took a weekend course on notes and it changed my whole entire strategy. And I started doing seller financing of a bunch of my single family homes to international clients, IRAs, and helping structure 1031 exchanges and selling the paper on the secondary market. And you start getting these little, it's just that idea in your head that you're like, okay, I could do that, and just move it forward. And through doing that, I had to spend a bunch of additional money on top of the weekend course with consultants and attorneys and learning what I can and can't do and problems with that. But that's all paying for education. You pay your attorneys and CPAs and other people like that to help you with that level of knowledge. So it's really, really valuable. But that being said, we're going to open it up to questions. If anybody has any questions, you guys are like, yeah, I don't know what to say. So question in the back.
Yeah, your 60-day bootcamp buyers. Yes. Your 60-day plan. Is that for flipping? Is that for general real estate investing? What is it?
Great question. We in the 60 days we focus on wholesaling because it is just 60 days. And my whole point behind that is if you learn how to wholesale, you will learn all the fundamentals, meaning how to write the offer, how to negotiate, how to talk to investors, how to create relationships, how to find a deal, most importantly, how to analyze the deal. And so, I tell people, especially flippers, it's a good skill to have to understand wholesaling, because I know for me, I don't want to, every house I get under contract, I actually don't want to do if it's too far away, for example, so just knowing that basic understanding of how to wholesale a property is a great, foundation, I guess maybe is what I want to call it. And, people in the 60 days, I'll tell you this, I know what happens. Either they figure out in that 60 days that they love this real estate thing, or in that 60 days they're like, oh shit, I can't handle this, I'm out. Or on the third case scenario, say, okay, now I get it. Now I can be a private investor, or I just want to buy and hold. And
that's good too. You have to love what you do, in a way. Yeah. And then
dealing with the grind that you got to deal with, doing 78 of these things in a year. It's like he was. Where were you right before this? You were coming in right from another listing, right?
Right. So you have to love driving too.
Yeah. You deal with a lot of international clients in different areas. How is that different than dealing with like investors here?
Education. It requires a lot more education.
And do they have problems getting money out of the countries that they're in and stuff like that, or what issues come up with that?
They do. They always have that regulation. And I'll tell you how to move money later. From other countries.
From any other country. Okay, I gotta talk to you.
Yeah, no, we're on Facebook Live right now. That doesn't happen.
Other than that, it's more the education. How we have MLS here. International people, a lot of them don't. So when they list a home, they would like to list a price that's so high off the sky, and waiting for people to negotiate. So something we have to educate them on, the comms and records we have.
Interesting. We deal with a lot of the tax differences and dealing with a lot of the international investors bringing money here and stuff like that.
Tax withholding, it's a different thing.
Right. Question over here?
Well, in the shifting market right now, what precaution are you taking in your luxury sector?
That's a great question. What precautions am I taking during this market shift change, if you will, for lack of a better term? As of September, basically 1st, I saw that things were changing. DOMs were going up, days on market. There was a consistent price drop of listings. We don't have still, inventory levels are still low, but you can just see a lot of the price drops. So I see the writing on the wall that there's a correction coming. From that point on, I've been scrambling to finish up my projects as fast as possible, get them to market, get them sold. If I have to take a razor cut on my profits, then so be it. Somebody asked earlier what's your alternate strategy, so if this doesn't flip. My alternate strategy was never to hold it, because they would never cash flow, they would never even break even. They wouldn't even be in a negative where I'd be comfortable. So the plan B for me in any of my flips has always been sell for less, and if I have to take a loss and make it up on the next one. What am I doing now? I am getting rid of all of my stuff and then move forward very, very cautiously. I have one project that I've been working on for a year now. It's a short sale. It's a home run of a deal, so assuming I get it, my attorneys are working on it right now. If I get it, that's really the only thing I'm going to buy right now. I've moved over to the commercial sector more, where I'm doing apartment buildings and commercial stuff, and then mostly I'm just focusing on finishing up my projects and doing the service industry with contracting. I have no risk there, so you hire me, I do the work for you, you flip it, you go, and I get paid. That's really what I'm doing. I'm going to sit and wait and see what happens.
Also, I would recommend, look, if you're flipping, build in a price correction into your flip, 5% or something like that over that period of time. It may go down 10, but you at least, you're still in that kind of position if it took a whole year of a big project. On a buy and hold type investment, build in some extra buffer room in case rents drop by 10% or 5% or something like that. I don't know that it's not going to really happen in California given the demand probably here for rentals, but in a lot of the different areas around the country, look at what happens during the last crash to rents, in those areas, and be monitoring the data consistently on a monthly basis to see what's happening on the MLS, the days on market, the pricing, what's happening with price drops, all of those things, be abreast of all that stuff so that you know what's happening, and you should be able to mitigate as much as you can there by doing those mitigation techniques. So
the cost for financing will go up because of days on market is getting longer. So take that into consideration.
Yeah, that's true, for sure. Yeah, that extra.
Is any chance we can, instead of one person to buy the house, rental house to make the investment, is any chance we can join the money, make a big project to invest?
So you're talking about like a syndication or a pool of investors. So there is a lot of different syndications out there. Like I've invested in self-storage funds and mobile home park funds and all kinds of different stuff that the trick with that is that what you're doing is you're giving up control over the asset for a manager to come in and manage that for you for proper diversification. But the issue is you need to make sure that manager knows what the heck they're doing and has a really good track record, and there's always a performance-based incentive involved, meaning they don't get paid until you do. So if there's a preferred return involved where you're making 7% or 8% on your money first, and then there's a split afterwards, then that's really, what you want to be finding. But you also want to understand the financial projections and be able to analyze those and say, are they lying on their financial projections? Are they being really optimistic? Are they saying rents are going to rise consistently for the next 10 years starting right now, or values are going to rise just with no rental increase or increase in revenue? So it's understanding how to underwrite a deal before you can invest in those things. That's why a lot of them are geared towards sophisticated investors that are accredited, that have really high net worth, and they limit the amount of non-accredited or people that are worth less than $1 million or have less than $200,000 in income on an annual basis. They limit the number of people that have that into a lot of these funds because they don't have the sophistication to go and look at a set of financial statements and read a private placement memorandum to tell you what clauses are going to screw you over in this giant long 90-page document, So a lot of times you want to read that, have your attorneys involved in those things before you invest in those. But they can be really, really good investments as long as you put smaller chunks of money into multiple of them to diversify your risk. So that's what I do is multiple markets around the country, multiple operators, and multiple asset classes, $25,000, $50,000 chunks across the board, across all of them.
Where I can find the connection?
So it's a matter, I have a couple of relationships I can send you that have these types of, they're constantly looking for deals and things like that in that realm, but that doesn't mean that you can trust their judgment. You have to be able to understand that, and they can share with you how to do that, and there's education out there for that. So, but.
I actually love syndication.
Yeah.
When you find the right one, they're truly passive.
Right.
Yeah.
Yeah, it's interesting, and they can work out well or not. So,
of course, yeah.
But that's why you're only limited to your risk on the amount of money you put in. So, question over here.
When you guys find a property yourself and buy it directly from the owner, you use different purchase contracts than what you see with a broker, because those are heavily regulated on stuff. So, can you tell us about
for me, I am not a licensed agent. And I choose to not be a licensed agent. My partner is a broker. But if I'm going direct, knee-to-knee with direct to seller, I can't use the car form because I'm not an agent. So my contract is a one-page contract, and it's very, very simple. And for me, it's more important that they understand everything on that contract. And then if they want to, bring it to their attorneys, they certainly can. But that's it. I try to keep it as simple as possible. If they want to add something to it, that's, just handwrite it in. But that's how I try to deal with them, where I'm not trying to complicate anything. That car form is like, 11 pages these days?
15 now.
Or 15? And it's not counting the addendums. And it's really more just to protect the agent and the broker more than anything else.
So they don't get sued,
If you dispel that down, the most important thing is, what's the address? What's the consideration? What's the price? And if you can agree on that, that's all you need. You don't even need, you can do it on a napkin, right, Clyde? You can do a deal on a napkin if you need to. And then,
it's really
something
funny.
as simple as that, I have done that on a yellow piece of paper, and I've taken that yellow piece of paper and sent it to escrow. And then escrow will then write up a purchase, escrow instructions. So just, so keep it simple.
Yeah, we and you never have them going to their attorneys, like literally 99.9% of the time. It's like, yeah, fine, we'll sign. The thing you run into is a title issue on some of those properties, or, people not realizing how much they really owe. And, we've had people sign contracts for beneath what their loan amount is, because they're like, oh, I thought it would just get paid off in like a short sale. You're like, it's not how a short sale works. So you have to go to an agent or something like that involved. So.
That brings me to another point. When you take these properties as a flipper, you buy title insurance, even though the contract's on a cocktail napkin, you buy title insurance?
Absolutely, because I'm using private lenders and I need to protect them. So I get title insurance, I get liability insurance, I cover all my bases to protect the lender.
I know there's people out there that you can just write a deed and that property's yours, but
that's not the way to do it.
I don't like that. I like to say keep my nose clean. So always open escrow, always have title insurance, homeowners insurance, obviously as well. To protect the property and
get lenders title insurance.
So that's just your liability insurance is your package for your hazard insurance. So you have hazard insurance for fire if it burns down, theft, that sort of thing. And on top of that, you have liability coverage you can have. You can do a $1 million, $2 million, $3 million balloon, and it's very affordable to add that. And so if you got somebody that slips and falls on the property, you're protected with that insurance policy. And the way you protect yourself is through entities. So you're utilizing an LLC or an S corp and owning that instead of your personal name. Now, if you have no assets to your name, you're not risking anything. You can sign contracts and take ownership via your personal name. If you have assets, you want to protect them, buy property and hold it into the entity, because that's protection phase 1. Protection phase 2 is your insurance policy.
And the insurance.
Is that just like homeowners insurance?
Well, if you're doing a flip, then you need to buy. You can't buy homeowners insurance. You need to buy vacant property.
It's like builder's risk coverage
or builder's risk. There's two. Builder's risk takes it even a step further. So on a property, you're doing a non-owner occupant purchase. You need a non-owner occupant insurance coverage. You can't say I'm living in a property. If that place burns down and the fire department's there and doesn't see any evidence of a bed and food and all that, guess what the insurance company's going to tell you? Yeah.
And same thing
Have a
goes.
nice day, see you later, denied.
Yeah, same thing goes with like short-term rentals, because there's clauses in most insurance policies, even for renter policies, that it can't be used for that unless you have a specialty policy. But now there's specialty policies for those that will give you loss of rents coverage equal to your actual rent that you're collecting on things and stuff like that. So it's, you got to have a really good insurance company or agent or broker that understands your situation to say, look, this is how much you're worth. And, it's almost like in coercion with your CPA and your attorney here, along with your insurance agent, to say, okay, what's your legal structure and your tax structure? Now, what's your net worth as far as insurance? Can you get an umbrella? You want to have workers' comp insurance for any guys that are working on your job, or make sure the contractors have it along with their general liability policy, so that, that gap coverage when your insurance company says, well, we weren't covering workers' comp, that's not on your policy, you better make sure that guy has it and they have a general liability policy too, because a lot of times it's their subs or something like that will fall on you as far as liability goes. So, makes sense? We got time for one more question, and that's it. If not, we're going to start with networking. Okay, everybody's quiet. Perfect.
I want to add really quickly on the title insurance. You never buy the home without title insurance, because now you have a broken chain of title. You're going to have some trouble when you're selling. So let's say even you have a divorce, you got to settle that. Try to get it on title as clear as possible to you.
Yeah, it's really important, the title piece, because a lot of times you can transfer property with a quit claim deed, but a quit claim deed just means that you're giving whatever rights and ownership you actually have to that property, which you're not certifying that you even have any rights to that property. But if you have a warranty deed, then typically that's like, yes, I'm certifying that I have the rights for this. It's recorded, title's taken care of. So, these kind of transfers of ownership, we say napkin paper contracts, but that doesn't mean napkin paper protection on closing and that kind of thing, so, but okay, well, thank you guys very much. Feel free to come back next time, and we'll be talking about using other people's money. So look forward to having you guys again, and feel free to network.